Receiving a dividend payment in your account feels like winning the lottery. You get that notification, it's like, oh, okay, that's nice. And it can make the investment journey seem much more fun. Opposed to just checking once a month or every 6 months, you can get steady drips of income along the way. But picking the right dividend companies to invest is much harder, because payments are great, but also we want ones that are going to grow, so we get returns plus a dividend, which is happy days.
Come on! Yes!
So here's 3 dividend companies that have been beaten down right now and I think could make great additions to your portfolio. And the last one is quite interesting, so I'd love to hear what you think about it. And remember, this isn't financial advice, just something I think is really fun to look at, so please do your own research. If you'd like me to do more of these, please let me know by hitting subscribe, like or dislike, as it gives me great feedback on the types of videos you guys would like to see. Okay, first up we've got Direct Line with the ticker symbol DLG. One of the UK's biggest insurers, offering all types of insurances: car, home, pet, life and travel, just to name a few. The company is down a whopping 22% over the past year and 41% over the past 5 years. Now, I'm not going to lie, insurance is pretty boring business. It's certainly by no means the next Tesla where you're going to see insane returns, but it's a reliable, well-established company that's been going since 1985. And in uncertain times, boring can be good. The main reason for this decline has been that insurance premiums are on the rise, coupled with the fact that there's a lot of volatility in the car market. The firm is expecting to improve its combined operating ratio for 2023 to 95% and their total premiums to be around 1.52 billion. The company's down to its lowest level since 2012, which makes for what could be a good buying opportunity with the increased dividend yield. Looking at the financials, the PE ratio is very low, 10 times the earnings compared to the industry average of 23.9 times, a very good sign. A fairer PE ratio of the company is suggested to be 14 times, and using a discounted cash flow model, we can see the company is recommended to be 52% undervalued, currently at £2.6 and a fairer value being £4.36. Some analysts believe it'll get near that figure, but some believe it'll be much lower. The average price target comes out at a 23% gain in a year, which is still a solid return. As you can see, the earnings potential for the company is pretty static, pretty much what you'd expect for a long-established insurance company. A really strong point with Direct Line though is their assets, which do outweigh the liabilities. Their current dividend yield is where they really shine though, 11% dividend with the industry average of 4.7%. Worth noting, it was cut during the COVID pandemic, but even before this, it's hovered around the 10% mark. This stock's usually not one I'd consider, as if you don't know, they don't use price comparison websites, so you have to call them direct. I think this has been a strong selling point for the company standing their ground and not competing purely on price, and a lot of people do like using them. But for me, I wonder how that will fare in 20 years time, as I imagine their client base perhaps be slightly older. I certainly compare online every year for my insurance to get the best deal. And with everyone feeling the cost of living crisis, maybe they'll be doing the same. But if I didn't already have such a large stake in Aviva, these would be on my hit list for the short term. 11% yield with a potential 23% gain seems very tempting. Next up, we've actually got a company you might not expect, which is a REIT, or a real estate investment trust, which is the Urban Logistics REIT, ticker SHED. They provide high-quality logistic properties, i.e. warehouses, which enable their tenants to operate the essentially modern distribution networks demanded by e-commerce. Essentially, buildings that are in demand for online shopping companies. They own and operate more than 100 warehouses across the UK, but recent panic selling of UK assets has pushed the prices of a lot of top property stocks sharply lower, which could make Urban Logistics a nice buy. Because of it being commercial property, it can be somewhat shielded against inflation. Inflation has just hit a 41-year high, and when that happens and the rate goes up, these warehouses are also able to increase their rates to go along with it. Now, there is the argument that some companies won't be able to pay increased rates, but for a lot of them, they are essential. Unless the company is going to fold, a huge logistical change is not easy, so they'd rather pay the increased rent. The demand for warehouses across the board should be set to improve quite quickly. Rents are looking to improve, as well as there not being a very strong outlook for construction of new properties in this sector. Supply versus demand demand could help it quite significantly. There's also the consideration that e-commerce will continue to expand as it has been. Maybe even more so, as more companies are looking to reduce their physical locations and move online, as we've seen over the past few years with some of the big high street brands. Physical locations in some cases just don't make sense. The REIT is down 17.87% so far this year, but over the past 5 years it's up 16.62%. And you can see on the timeline it looks to be in quite an attractive position right now. The price to earnings ratio is currently at 5.4, slightly below the industry average at 5.9, with a fairer P ratio suggested to be 6.2. The share price looks attractive, with the company currently being 17.1% undervalued. Current price £1.43 and a fairer price suggested to be £1.72. Price targets also look good for this company, with the 1 year price target being 26%, with analysts in agreement, which is always a good sign. A consideration with this company is its debt to equity ratio of 35%, which could be considered high. It's tricky to know as they are working in property. I would expect a company like this one to have quite large mortgages on the properties. The dividend is currently 6.1%, which is higher than the industry average of 4.4. Worth noting, the dividend has been lower in the past at 3% levels, but they even paid a dividend through COVID, which is surprising. And it seems set to level out and hover around the 6% mark for the next few years. So if the 26% price growth can be achieved in the next year plus a 6% dividend, it seems like a nice stock to consider. Huge thank you to CoinJar for sponsoring this video. If you haven't used CoinJar, they're an FC8 compliant, very safe crypto provider, which have got a crypto card launched in the UK. They've currently given me a bonus, so if you go and sign up, you will get £10 for free, which you can add to your account, and then you can go and spend it on your crypto card. So you can have £10 for free to make your very first crypto purchase. An actual real use case. Now, my last stock is interesting. I would consider this higher risk than the other two options here, but I'd love to hear what you think.
3, 2, 1, see ya.
This one is Persimmon, a UK house builder who's focused primarily on first-time buyers and the affordable housing market. Like other house builders, Persimmon has been slaughtered in 2022 so far. 52% down in the last year, 55% year to date, and when we look over the past 5 years, we can see how far down they are now compared to where they were. This is partially due to the housing market, but also the post-Grenfell cost of replacing cladding has come in at 350 million, 4 times the 75 million it told investors it would cost in August. It said this cost was due to a broader scope required by the government, which isn't great. But financially, they're interesting. Its P ratio is 5.6, where the industry average is 8.1, with a fairer profit to earnings ratio being 10.2. It's currently 25% undervalued with a current price of 12.82, with a fairer price being 17.23. No one's expecting a rapid recovery, but the average price target is 27.2% over the next year. Worth noting though, its earnings are expected to decline over the coming years. The reason I had to mention Persimmon though is this. I'll just leave that dividend right there. Yep, 18%. Now that has ranged in the past, it's been as low as 0 and as high as 10. The main reason it's showing up so highly is the current price. I do expect that to be lowered as it's insane, one of the highest I've ever seen and a huge amount the company would have to pay out. But even so, I'd expect it to have a reasonable dividend yield. The really interesting thing with this one, yes, house prices are now forecast to drop in the next year, but the question is that already priced in? It's not like there's going to be some shock to the system when they do drop. Now of course this company could perform even worse, as could any stock. But the question is, investing in the company at this point when it's at one of its worst stages, a company that's been going since 1972, focused on first-time buyers and affordable homes, which the government may very well have to step in and offer more incentives and more funding towards affordable homes, weather this storm, come out successful while paying you a dividend. A very interesting question, and let me know what you think in the comments down below, as I'm really interested to hear whether you think this is a good option. I hope these gave you some ideas on nice dividend picks to add to your portfolio. If you haven't already, check out this video which could help you beat the recession by 55%, and I will see you over there.